What's going on, world? Thank you for watching another episode of Insightful Principles. In today's content, I want to talk about what everyone is talking about here more recently with Silicon Valley Bank and Signature Bank. Some of the failures that we're seeing within the banking system with these two major banks. I really want to break down what happened with these two banks and how the Fed had to step in to make sure that the depositors were whole, and really just talk about what it means for the economy. What it means for you that's actually banking with another bank. How to really mitigate risk for yourself, as a person that's banking with a lot of these larger institutions, as well as how to look at it as an investor, and how this could potentially cause a bigger effect with the global economy and other things like that. But as always, so if you all could please do me a huge favor, don't forget to like, subscribe, and share. Don't forget to also hit that notification bell below so you can be notified every week when I drop content. So Silicon Valley Bank, this company was the largest bank failure since the global financial crisis that we had in 2008, when Washington Mutual actually went bust. And it actually was the second largest collapse in U.S. history. Now, this company is based out in Santa Clara, California, and they actually were the 16th largest bank within America. Now, as some of you may know, some of you may not know, SVB has a lot of exposure within venture capital. They tend to also help lend to other startups, and mainly the industries that they focus on is technology, life sciences, and also the healthcare industry. And they have played a major role within the venture capital ecosystem, and they do provide financing and banking services, like I mentioned, to startups and also investors alike. Now, in the case of Signature Bank, they're a New York-based commercial bank, and they actually were founded in 2001, and they primarily serve small and mid-sized businesses. They also, in 2018, recently got involved within cryptocurrency. So some of their branch within their business model is they also do financing within the cryptocurrency space. Now, in the case of SVB, a lot of the startups that they were investing into and a lot of the exposure they had in venture capital, a lot of these companies started to have issues when interest rates started to rise, and a lot of these companies were becoming unprofitable. And as interest rates continue to increase, as they have been over the last 2 years, a lot of these investments that they have made have become unprofitable. It caused the market for initial public offerings, which are IPOs, to shut down for many startups, and it made private fundraising much more costly. And in order to be able to combat against these losses that SVB were seeing with their unprofitable investments that they made with their startups, with the venture capital, they actually went and bought long-term dated bonds when interest rates were near 0%. Now, at the time, back in 2021, this might have seemed like a good idea, but as interest rates began to rise, those long-term dated bonds started to lose significant value, because as interest rates start to go up, bond prices go down. And longer term dated bonds tend to be much more volatile than short term dated bonds, because they're more at risk of the fluctuations of interest rates. So when you have a long term dated bond for 20 or 30 years, if interest rates are going up close to 5%, your bond that you're earning a 1 to 2% interest on, holding that over 30 years doesn't make sense when you see that your bond value has dropped tremendously because of the higher interest rate environment. Whereas someone that has short dated bonds, they have a much more closer term to maturity, which all that means, maturity means is when the bond actually expires, when it meets its maturity. You don't have as much interest rate risk, because your bond is going to mature much faster than a bond that's 20 or 30 years. So if you have a 2-year bond, that's not going to have as much interest rate risk as a 30-year bond, for just an example. Now, the banking model that we have here in America is a fractional reserve system, and they tend to borrow short and lend long. So what that means is most of the deposits that are put into a bank automatically is going to lend out 90% of that. 10% is what they're going to actually keep within the bank as reserves. And a lot of times when they're lending out that 90%, they'll do financing such as credit cards, auto loans. It could be mortgage debt. It could be student loans. And then in the case of SVB, what they were taking with some of those deposits to help offset some of the losses with their venture capital exposure that they had, they were actually buying those long-term bonds. And what happened was, as these interest rates started to become higher and higher, they're starting to lose money on their bonds. And then as this started to build up, SVB, it was disclosed that they had a $1.8 billion loss, and they needed to raise capital to be able to address the demand of their depositors. And as the stock continued to fall on March 10th, which was this past Friday, many depositors wanted to take their money out of the bank because of the liquidity issues that they were seeing. Now, this was a bank run that SVB, they simply weren't prepared for it, and they couldn't meet the demand of their deposits because most of the customer deposits were in those long-term dated bonds that I mentioned, and those bonds are losing significant value. So they're not worth as much as what they might have been worth when they first bought the bonds in 2021, for example, when interest rates were near 0%. So that just goes to show that SVB, they didn't have enough cash to be able to fulfill their customers' obligations, and the FDIC actually had to step in. There were state regulators that had to step in for Signature Bank and actually had to take over because of the solvency issues that these banks had. And more recently, the Fed announced on Sunday that they are creating a new lending program. And with this new lending program, the way it's being described, they're basically aiming to provide extra funding to eligible institutions to ensure that banks have the ability to meet the needs of all of their depositors. And the U.S. Central Bank pretty much stated that they're prepared to address any liquidity issues that any of these banks are going to have. And this new lending program is going to offer loans for up to 1 year to lenders that pledge collateral, including U.S. Treasuries and other qualifying assets, which will be valued at par. And they also just described that this is going to eliminate institutions' need to quickly sell those securities in times of stress. And it would be enough to cover all uninsured U.S. deposits. And actually, the new lending program is going to be providing about $25 billion. And the reason why they are mentioning that this is going to eliminate the need to quickly sell those securities in times of distress, because this is exactly what SVB had to do. They had to sell a significant amount of their bond value at a loss in order to be able to help service some of the requests that they were having from their depositors. Unfortunately, it still wasn't enough. That's why the FDIC had to step in, and ultimately the Federal Reserve had to have this so-called backstop to be able to help a lot of these banks. And also, it has been talked about that with SVB, a number of venture capitalists have said, both with Signature Bank, more specifically, they were more exposed than SVB because they also had a lot of concentrated customer base. They had significant exposure to cryptocurrencies and technology companies, and they had a high proportion of uninsured deposits. And I actually read that Signature Bank had about 89 billion of their deposits. 90% of that was not insured by FDIC at the end of last year. And I also read that with SVB, they had about 89% in uninsured deposits. So it just goes to show you the amount of financial stress that a lot of these banks were going through, and it really wasn't enough proper risk management because they shouldn't have had so much in long-term bonds, but they probably thought that the Fed wasn't going to raise rates as fast as they have done. So they thought that it was a great idea because essentially they were purchasing cheap. They were purchasing cheap money at that time, and it was essentially cheap debt because they were taking a lot of the financing that they had with interest rates being so low. They put it in long-term dated bonds because they ultimately thought that the return was going to be much higher. But I definitely think that the proper risk management wasn't in place, and they really didn't thoroughly hedge their losses accordingly to be able to balance against this risk. And there were a lot of companies that were involved that had exposure to SVB that, now a lot of the depositors have been made whole because the Fed and the FDIC had to step in. But you still had Roblox, which is an online gaming firm. They had about 5% of its $3 billion cash and securities balance held in SVB. You also had Roku, which is a streaming device company. They had about $487 million held in deposits with SVB. And even you had Circle, which is USDC, which is the cryptocurrency stablecoin that Circle actually administers. They actually are the owners of this stablecoin. They had 3.3 billion of its 40 billion of the USD coin reserved at SVB. So it just goes to show some of the exposure that a lot of these other industries had within SVB. And I think a lot of people are questioning, okay, what will the Fed do? Is the Fed going to pause rate hikes because they may feel that they've raised interest rates so high to the point where a lot of these banks are experiencing financial stress? And then on the other end, a lot of people are saying they have to continue to keep raising rates because inflation, the recent print that we had on March 14th, which was Tuesday, showed that inflation year over year is still around 6%. So it's went down slightly, but inflation still is not going down as fast as they would like it to be. So I think that also poses the question that they're really in a tough spot right now. Of course, there's a lot of things starting to break within the economy. We're seeing it in the regional banking sector. And I also was looking at the market today, and it's showing that now the European banking sector is starting to see some issues. On March 15th today, as of 12:18 Eastern Standard Time, when their market closed, Credit Suisse has been down a lot today, and there's a lot of other European banks that are starting to see some issues as well. So it's yet to be determined how this is going to totally impact the global economy, but I do think it's going to be more volatility. But I think that, if you're a person that, has a bank, you're with a larger bank, I think one way to mitigate risk, if you're a business, if you're an individual, is, you got to look at having multiple banking relationships. You have to be diversified. Never have all of your money in one institution. It's just like with investing. You don't want to have all of your money in one asset class. You don't want to have it all in one asset. You want to have multiple different assets. So you want to be diversified. And it's the same mindset you want to have when you're banking with your institution. Have multiple relationships. Understand that you have to mitigate your risk. If you have over $250,000 held at one bank, you want to make sure that you are limiting any type of financial turmoil if these banks have a collapse, if they have failure. So I think what we have seen with Signature Bank, with Silicon Valley Bank, it really opens up our eyes to understand that we really live in a system that it's a fractional reserve banking system, and they're highly leveraged. Banks by nature are highly leveraged. When you think about that, 90% is being lent out and only 10% is being held as capital in the bank. That's just 10 times the leverage, 20 times the leverage that these banks are having. So I think there's tremendous risk within the banking system. And I think as an investor, as a person that is banking with different institutions, you have to be wise. You have to be aware of some of the issues that we're seeing. and really just staying the most prepared when it comes to mitigating the risk. But I thank you all so much for watching this episode. Please continue to like, subscribe, and share this video. Don't forget to hit that notification bell below so you can be notified every week when I drop content. And I thank you all so much for watching and listening, and have a blessed day.